Warren Buffett has made thousands of investment decisions over 60 years. He's built one of the greatest fortunes in human history, but if you ask him what the dumbest stock he ever bought was, he doesn't hesitate. It's the company that made him famous. So in this video, I'm taking a deep dive into how the greatest investor alive made a $200 billion mistake that still haunts him to this day, and what it might mean for the stock sitting in your portfolio right now. So let's get into it. Hi, I'm Jacob Wade. I'm a financial coach that helps high-income earners retire early. And I love studying the greatest investors of our day to learn how to build wealth smarter. And if you enjoy videos like this, go ahead and hit that like button below. It helps me know to keep making more deep dive videos just like this one. So first, let's rewind all the way back to 1962 when Warren Buffett wasn't Warren Buffett yet. He was a 31-year-old running a small investment partnership out of Omaha, Nebraska, about $7 million under management. Today, they'd call that a hedge fund, but back then, he was just a guy with a checkbook and a thesis. Now, he'd been trained by Benjamin Graham, the godfather of value investing. Graham's whole philosophy boiled down to one simple idea: buy things that are cheap. Find stocks trading below their liquidation value and just buy them. It didn't matter if the business was good, it only mattered if it was cheap. Now, this is the lens that Buffett was looking through when he found a stock called Berkshire Hathaway. It was a textile company based in New England, and it was dying. But it was dying in a very specific, predictable way that caught Buffett's attention.
And here was this cheap stock, cheap by working capital standards or so, but it was a stock in a textile company that had been going downhill for years.
And here's what's interesting about this stock. Buffett wasn't exactly a rookie. He was actually a brilliant, disciplined, and already successful investor. So investing in Berkshire Hathaway wasn't a beginner's mistake, which is exactly what makes it so important. So what was Buffett actually doing with Berkshire? He didn't actually care about the textile business at all. He was playing a completely different game. Now, Berkshire had once been a massive textile operation, but by the early 1960s, it was shrinking. Management kept closing the textile mills, and every time they closed one, they'd use the proceeds from that sale to buy back more stock. Buffett had spotted this pattern.
It was a huge company originally, and they kept closing one mill after another. And every time they would close a mill, they would take the proceeds and they would buy in their stock. And I figured they were going to close. They only had a few mills left, but they would close another one. I'd buy the stock, I'd tender it to them, and make a small profit.
Now, this was what Benjamin Graham called a cigar butt investment. You'd find a stock so beaten down, it's trading below the value of its own assets. There might be one good puff of value left in it, hence the cigar butt. You take that puff and you move on. The business doesn't need to be good, it just needs to be cheap. And honestly, this was working. By 1964, Buffett's partnership had built up a significant position in Berkshire Hathaway. He was playing the pattern perfectly until the day he went back to visit management. Now, before we finish this story, if you're enjoying this type of deep dive, hit the subscribe button below and hit that little notification bell there so you don't miss any future videos from this channel. So in 1964, Buffett actually went out to visit Berkshire's management. The company was run by a man named Seabury Stanton. Now, Stanton knew Buffett held a lot of stock and he had a proposal for him. The company had just sold some mills and had excess cash. They were going to make a tender offer to buy back the shares. Now, Stanton looked at Buffett and asked him, "At what price will you tender your stock?" Buffett said $11.50 per share. Now, Stanton asked him to promise, and Buffett actually gave his word. But a few weeks later, a letter arrived in Omaha addressed to Warren Buffett.
And here it is, a tender offer from Berkshire Hathaway. That's from 1964. And if you look carefully, you'll see the price is 11 3/8. He chiseled me for an eighth.
Now, just pause to think about what that means in dollar terms. An eighth of a point of the stock price in 1964. We're talking about pennies here, a rounding error, but it wasn't about the money. It was about the principle of the thing. The man had looked Buffett in the eye and asked for his word and then broken his own word when he offered 11 3/8. So Buffett got mad and he went out and bought every share of Berkshire Hathaway he could find. He bought enough to take control of the entire company, and then he fired Seabury Stanton. Now, Buffett felt great in the moment, but by Buffett's own admission, this was actually the beginning of a $200 billion mistake. So Buffett now controlled a textile company. And not because it was a good investment, but because a man had made him angry. He committed a major amount of capital to a terrible business for an emotional reason. And this is where the real cost begins. Now, in 1967, a great insurance company came along, National Indemnity. Buffett bought it, but he bought it for Berkshire Hathaway. He should have actually just started a new entity entirely, but instead he bolted a great business onto a dying one. And for the next 20 years, that textile operation was an anchor dragging down everything Berkshire tried to build. And here's the numbers. Berkshire's textile division had about $20 million in net worth and was earning essentially nothing year after year after year. And meanwhile, the insurance business and subsequent acquisitions were compounding brilliantly, but always carrying this dead weight of the textile business. And Buffett even tried everything: new equipment, new mills. He even bought another textile company, Wambach Mills in New Hampshire, thinking there would be synergies, but there weren't. And he once even joked that if he'd approved every cost-saving proposal on his desk, the company would supposedly be operating with 0 employees. But, it never works that way. And he actually had a wonderful manager running the textile business, a guy named Ken Chase. He was honest, able, hardworking, but even Chase couldn't make it work because it wasn't really a people problem. It was a business problem.
If you get in a lousy business, get out of it. I mean, it was a terrible mistake just because I drifted into it in a sense. And I've always said that if you want to be known as a good manager, buy a good business.
The problem was Buffett didn't get out of the business, not for 20 years. Now, when asked how much this mistake cost him, Buffett actually puts a specific number on it: $200 billion. And keep in mind, this interview was years ago, so it's probably more like $300 to $400 billion at this point. If he had actually taken the money he put into textiles and actually just started with the insurance business from day one, no anchor or dead weight of this dying textile business, Berkshire Hathaway would be worth twice as much as it is today. Twice. Let that sink in. The greatest investor in history with a 60-plus year track record believes his single worst decision didn't lose him money in the traditional sense, but it cost him opportunity. Money wasn't lost, it was trapped. It was stuck in a business that couldn't compound while the clock ticked on decades of potential growth. Now, this is the concept of opportunity cost, and it's the mistake most investors never realize they're making. Maybe you look back at your portfolio and think, I haven't lost money on this position, so it's fine. But the real question isn't whether the stock is losing money, it's whether your capital could be compounding faster somewhere else.
Brilliance meets up with a business with a reputation for bad economics. It's the reputation of the business that remains intact.
Now, here's how it applies to you. Ask yourself, how many stocks in my portfolio right now are cheap, but not really going anywhere? And how long have you been holding a position that isn't losing money, but also isn't making any money? That's the Berkshire textile trap. You're not really losing, you're just not compounding. And over 5, 10, or even 20 years, that's the most expensive mistake you can make with your investments. Now, there's an interesting footnote to this story that Buffett himself brings up, and it might be the most important part. His business partner, Charlie Munger, had actually been telling him this from the very first day they met in 1959. 5 years before the Berkshire mistake had even happened. Now, Munger's philosophy was simple and it directly contradicted Ben Graham. Don't buy cheap things, buy good things. It's much better to buy a wonderful company at a fair price than a fair company at a wonderful price. Buffett heard this advice. He understood it intellectually, and he still spent 20 years learning it the hard way. That's worth sitting with for a moment, because knowing the right answer and actually living it out and doing something about it are two completely different things. I would say Buffett put it best himself. He said, I could have saved myself a lot of trouble if I just listened to him. But what did Charlie know? He said it with a laugh, but there's a real way behind it. The man who became the most trusted partner had the answer from the beginning. Buffett just wasn't ready to hear it. And honestly, this is relevant to every investor watching this video. You probably already know on some level which positions in your portfolio are anchors. The question is whether you'll act on that knowledge now or whether it'll take you 20 years too. By the way, if you're looking for more stock market analysis, WallStreetZen's editor-in-chief Steve Reitmeister does live market analysis every Monday at 7 p.m. Eastern Time, and you can join him for free. Every week, he walks through not just what he's buying and watching, but exactly how he's finding these opportunities so you can replicate the process yourself. He also shares his handpicked stock of the week, where he combines the power of the Zen ratings model with over 40 years of investing experience to find ideas you won't hear anywhere else. It's called the Wall Street Zen live training session. It's completely free and it's coming Monday at 7 p.m. Eastern time. So you can sign up at wallstreetzen.com/live. There's also a link in the description below, or you can just scan the QR code on the screen right now. Now, after everything, the spite purchase, the 20 years of fighting a losing business, the $200 billion in lost opportunity, Buffett never actually changed the name. It's still Berkshire Hathaway. The failed textile company from New Bedford, Massachusetts, is now the name on a $1 trillion conglomerate. Now, why didn't he change the name? Well, Buffett has never really given a definitive answer on this, but the name itself serves as a permanent reminder. Every time he sees it, every time he has to sign a letter, every time someone says Berkshire Hathaway, he's reminded of that lesson. Don't buy bad businesses, no matter how cheap they are. Don't make investment decisions out of emotion. When you find yourself in a hole, stop digging. And honestly, most people try to hide their mistakes, but props to Buffett, he turned it into an entire brand. All right, so how can you learn from this story and put it in action? Here are 3 principles. Number 1, cheap is not the same as good. A low valuation on a bad business is not a bargain, it's a trap. Now, before you buy anything because it looks cheap, ask yourself, is this business actually getting better? Are revenues growing? Are margins expanding? Is there a reason to believe that this company will be worth more in the next 5 years? If the answer is no, the price doesn't matter. Don't buy it. Now, principle 2 is that opportunity cost is the real killer here. Now, the money you have tied up in a stock that's going nowhere is money that isn't compounding somewhere else. Every year that a dead position sits in your portfolio, it's costing you, but not necessarily in losses, but in gains that you can't get somewhere else. Time is the one resource you can't recover. And principle 3 is knowing the lesson and living the lesson are actually 2 different things. Buffett knew the textile business was bad, but he kept at it for 20 years. Munger told him from day one, and he didn't listen. Now, the hardest part of investing isn't learning the right principles. It's actually following them when your ego and your emotions or your stubbornness get in the way. So just do this. Take 5 minutes today, look at your actual portfolio and ask yourself honestly, am I holding any anchors here? And if Buffett could admit this, I bet you could admit yours too. Now, Buffett closed the interview with a line that stuck out to me.
It's much better to buy something that's good at a fair price than something that is cheap at a bargain price.
20 years of fighting a dying textile company taught him that. It doesn't need to take you 20 years to learn the same lesson. Now, if this story changed how you think about even one of your positions in your portfolio, drop it in the comments below. What are the anchors that you're going to cut this week? I would love to know which stock that you're rethinking now. And if you want to dig even deeper into how to find winning stocks, check out this video right here where I review the best stock market websites for research and analysis.